Every stock we cover on this channel goes through the same process, a full automated analysis that scores the business across several factors and finalizes to a composite verdict. The goal is simple: cut through the noise and figure out if a stock is worth your money, worth watching, or worth avoiding altogether. No hype, no guessing, just the data, the levels, and a clear take. Let's get into it. A digital intelligence company with 79% gross margins, positive free cash flow, and our short-term model screaming strong buy, yet our overall system still says, watch, don't buy. Here's exactly why. SMWB, Similarweb, gets a watch rating today with 49% confidence. Here's the two-sentence thesis. Similarweb has the bones of a quality business, high margins, growing revenue, and positive free cash flow. But the stock is currently trading above its base case price target, meaning the market may already be pricing in a turnaround that hasn't fully arrived yet. Until profitability turns the corner and price pulls back to a better entry, this one stays on the list. So what's the setup? Price is currently at $314, but here's the interesting part. A highly contested price area sits around 260. The stock has already moved about 21% above that. That's not necessarily bearish. Buyers are winning short term, but it does mean you may be chasing if you buy right now. The short-term structure reads neutral, essentially flat. The 3-month trend is also flat. The one bright spot, the 60-day forecast, is a strong buy signal with 63% confidence pointing toward a possible move to 4.15 to 461. That's the trade, but, and this is important, that signal is entirely technically driven. The fundamental model behind it shows 0% confidence. So treat it as a short-term setup, not a business conviction buy. Here's what Similarweb actually does. They sell digital intelligence data to marketers, researchers, sales teams, and investors. Think website traffic analytics, competitive research, market intelligence. It's a sticky subscription-style business. The 79% gross margin is legitimately impressive. That's the kind of number that, once operating costs get under control, can produce serious earnings growth fast. Revenue is growing at plus 11% year over year, and free cash flow just came in positive at $3.2 million, a real improvement. Those are the green shoots. But here's the problem. The company is still losing money. Net income is negative $7.5 million. EBITDA is still slightly negative, and the return on invested capital is around negative 5.75%. Meaning for every dollar put to work in this business, it's currently destroying value, not creating it. High margins mean nothing until they flow through to the bottom line. Current price, $314. Our model puts the base case target at $252. That's actually below where the stock trades today, implying roughly 20% downside to fair value under base assumptions. Bull case gets you to $371, which is modest upside from here. Bear case drops to $152. The 60-day technical target range is 415 to 461. That's the trade setup if momentum follows through. Key levels to watch. 260 is your line in the sands. If price breaks back below that, the short-term thesis is broken. For SMWB to become a real buy, here's the checklist. EBITDA has to turn consistently positive. 1 quarter isn't enough. Free cash flow needs to stay positive and grow, not just flash positive once. Revenue growth needs to hold or accelerate beyond that 11%. ROIC has to climb out of negative territory. The business needs to start earning its cost of capital, and price needs to hold above 260. If that level breaks, the near-term setup is gone. There's also a revenue quality flag worth watching. The reported revenue quality score is extremely low, which raises real questions about collections and recognition. That's something to track quarter over quarter. Bottom line, SMWB is a watch list name. The bones are good, gross margins are elite, cash flow is turning positive, and there's a live short-term technical setup pointing toward $4 plus. But at $3.14, you're already trading above the base case fair value. Profitability is still negative, and the fundamental model has zero confidence in the bullish forecast. Our composite model is barely positive. Conviction is 49%. This is a trade, not a hold. If you're a speculator, set your stop at $2.60. Target the 415 area for the 60-day window. If you're an investor, wait. The story isn't written yet. Like and subscribe for more breakdowns. Every stock goes through the same full scoring system, and we give you the verdict straight, no hype. See you in the next one.